Welcome to the Happy Cows Eat Smart podcast, brought to you by Novus AgriScience, where your dairy's business success is our passion. In our monthly podcast, we cover updates and insights within Federal Milk Order 33. Our team of expert ruminant nutritionists delivers research-backed, custom feed solutions tailored to your herd, because we know every farm is unique and no two solutions should ever be the same. We go beyond nutrition. Through robust tracking of herd metrics and financial benchmarking, we help you optimize costs, boost performance, and build profitability so you can focus on what matters: happy cows and a thriving business. So whether you're tuning in from your office or your truck, join us each month for insights, stories, and strategies that promote herd health, farm performance, and dairy success. Let's make your business thrive, one episode at a time. And now, Dr. Lawrence Jones will share his insights for Federal Milk Marketing Order 33.
Thank you, Ben. And I did change things up a little bit this month to address some of the questions that have been asked here recently. And I just want to make sure everybody knows that any of the comments I make are not intended to be trade recommendations. So I was asked kind of the question as to why did the Order 33 milk price change so quickly? We'll start by looking at the statistical uniform price, which was 1963. And kind of we plot that out, it came down $1.12, and you might say, well, that's a pretty big change. Again, we've been higher than this up at 26, and we've been lower than this at different times. And I went back and said, okay, what is a typical change? So our biggest change was back here in 2022 when we jumped up almost $2, but a typical month-to-month change is about 75, 76 cents, somewhere in there. It would take your statistical uniform price. It was quite a bit higher than what Minnesota, Wisconsin was at 1640, obviously lower than what Florida was at 2679. And most of the statistical uniform prices were in the teens, kind of up through that corridor, and then in the 20s along the East Coast. So how did you change relative to everybody else? And in fact, you were right in line with the Northeast, that you're down $1.12. And so I kind of want to go through how these look now. Class 1 came down 85 cents to 21.33 off of the high that we had last month. And we add $3.80 to that to get to your overall base Class 1 of 25.13. And the areas that are highest in Class 1 are the Southeast, so they're 75%. You're more like 32, 33. And of course, if Class 1 came down 85 cents, you're going to expect the Southeast to have dropped around that 85 cent mark, and that's exactly what happened. Now, Class 3 came down 46 cents to 15.42, not our low. Our low was back here in January at 14.59. And the area that's highest in Class 3 would be Minnesota, Wisconsin. At over 90% of their milk is Class 3. You're 45 and change. And then we would expect Minnesota, Wisconsin to drop that 46 cents, and that's exactly what happened. Class 4 came down $2.62, so that's what moved most of the milk prices more than anything. Again, off of the low of $13.55, so these are still very good prices. And one of the comments is, was this June price sustainable? And I would actually argue it's not. $22 Class 4 is just not realistic here. More 17, 18, 19 is probably the realistic numbers. The area that's got the highest Class 4 is Arizona, and I'm not quite sure why they haven't depooled more of that. And again, they were down that $2, so they came down the most. So overall, I would say that you being down $1.12 is pretty much right in line with how the classes changed, and had nothing to do with depooling. So where are we right now? So Class 4 is higher than Class 3. Again, these are as of close last night. So your Class 1 numbers are all going to be based on Class 4, because again, Class 1 is the higher of 3 and 4. Again, just to plot this out, Class 4 is higher than Class 3 all the way through here. But as I started putting this together, I started asking the question, we already know August Class 1 numbers, they're going to actually come down a fair amount to 1876, and today we're going to announce the September, and it's going to come down to 1686. So some of your lowest prices are going to be in September, October, I'm afraid. Overall, fat prices have been fairly stable, down just 2 cents to $1.67. Protein prices have been bouncing from that low of $1.94 off of that high of 301, and right now they're at 232, and this is probably what I'd call a local low, and these are looking like they're coming up here. Other solids are really caught in this 40, 41, 42 kind of price range. Again, they came up a penny. They look like they might be going up to 45, but I'm not sure that whey will allow that to happen. But if we look at your actual milk checks, they came down a little bit more than that $1.12, and part of the reason is that you lost components, and that always happens in July. Components always kind of drop in addition to the different price changes. The thing that's impacting your check more than anything is that PPD came down 66 cents. And if we think about PPD, it's really class 1, class 2, and class 4. Because again, these first three lines are basically class 3, and then the PPD is everything else. We just simply take your utilizations, your 33, let's call it, for class 1, 10% for class 2, 12% for class 4. This is how they changed. You would have expected the PPD to come down 67 cents. It came down 66. So again, that was completely in line with the changes in the different class prices. But your fat came down this month a little bit, but again, it's up 7 ticks from a year ago. So we're very strong on fat, but this time of year, we've always pretty well put the low in. Protein percent came down compared to last month, but again, we're up 5 ticks from last year. So this is the time of the year with low protein, but we're still up significantly from a year ago. So let's talk about export demand versus the growing U.S. Milk supply, because this is the elephant in the room, I think. And this is a graph of the export cheddar price, which is in red, and then our announced prices, which are in blue. And then the numbers that are here is the percent of the actual cheese that was exported. So for example, here we only exported 7% of our cheese back here in the middle of 2023. To me, what's going on is that we need to stay 30 cents below the export price to get double-digit exports. The latest data we've got is the export cheddar price was $1.84. Our cheese price was $1.56. That's at 30 cents. So until the export price gets up, I'm afraid that we're going to keep our cheese price 30 cents below that price. We did just get a global dairy trade auction yesterday. This looks kind of more into the future, but this has been fairly flat ever since back here in March. Cheddar was up a little bit. Everybody got all excited about that, but it went from $1.69 up to $1.70. So again, we've got very low cheddar prices on the world market. Butter is very high. We're $1.46 on the spot market. We're $2.26. As I usually say, we're making the wrong type of butter in order to export it. Non-fat dry milk came up 12 cents to $1.69. We're $1.78 on the spot market, so we're over top of global dairy trade. And DFA always puts out kind of the summary of the global dairy trade. And we look out 6 months, we've got cheddar prices that are in the $1.67, $1.70 range. So to me, that is really kind of scary, because that would say that our export prices are probably going to be $1.80, which is going to put our cheese price under pressure here. I pull this graph together every month to look at how much cheese was available for domestic use. So we've got how much cheese did we make, how much cheese did we export, how much cheese did we put into cold storage, and the rest was used domestically. And anytime this number is over about 35.5 million pounds a day, we have a tough time getting our cheese price up. For July, I've estimated the exports, because we don't have that yet. We don't have cold storage. And so I've got this at 35.8. And again, we had prices at $1.56. So that pretty well is in that scenario. If we're over 35.5 million pounds of cheese a day, that we're not going to have $1.70 cheese prices. And whenever we get the dairy products report, I always put together what I call a rolling demand. This is a 12-month average of complete disappearances. This is domestic, this is complete. And this is consistent with that, because before we started raising exports, we were about 39 million pounds a day. We had some export in there, so that says 35 is about where domestic demand was. We increased exports significantly, and so now we're very much dependent on exports. If we lose that 4 million pounds a day of exports, then that's going to have to significantly lower the cheese price. Do we see the supply of cheese going down? I just don't. I'm probably fairly bearish. This is the latest cow numbers, 9,677,000, pushing right up to about 9.7 million is where I think we're going to head here. So I put together my July estimates just for milk production. That milk production report will be out this Friday. I've got us up year over year about 1.1%. I've increased cow numbers by 4,000 cows. I've reduced milk per cow by 1.5 pounds. And I'm at 97.8% of the June number. Now, I think these numbers are probably a bit low. I suspect production is going to come in a little stronger than that, which is going to be a bearish number. Are we going to significantly reduce this herd size? Again, I don't see that happening. Our latest data is for July 26th. We slaughtered about 51,000 cows, less than we actually slaughtered last year when we had 177 fewer cows. We're running right at a 27% slaughter rate. In order to shrink this herd, we need to be somewhere between 30 and 32 is what I would say would actually be a stable herd size, and we need to get up here in that 35% slaughter rate if we're going to shrink it. But right now, the slaughter data would suggest that we're going to continue increasing cows. Now, there's been a lot of discussion about feeder calf prices and what's that going to do to the price of black calves at the sale auction. So this has come down a little bit. We were at $3.70 for the October numbers. We come down to $3.26. So again, we took 50 cents off of these 500-pound calves. But you got to remember, anything over $3, I think, is a fairly big incentive for people to continue to breed to black calves, because that's still somewhere over $600, $700, $800 for those calves. And I always like to look out at the Oklahoma auction because that gives us a sense of what's going on. If we look at these 5-weight animals, they're really pushing, that 425, 436. So they've been almost $1 over the board for quite a while here. As I talked to different producers looking at the beef checks this last week, they're still fairly strong, and I don't see any change in breeding cows to black bulls. So with all this, I'm going to kind of give you an estimate of what I see in the future here. So the biggest thing is for me to estimate cheese production. So I've got cheese production coming up all the way through April probably. And I've got a model that looks at what would cheese price be with that kind of production. Now, what's interesting is I had predicted a much higher cheese price in August because we were down in cheese production than what the trade is. So for me, this is suggesting that the domestic demand must have been particularly bad in July and August. But overall, right now, I've got prices in that $16 to $17 range through June of next year for Class 3. If we look at fat and protein, these are the curves for the next year, and I think fat is going to stay under $2, and protein is probably going to be around $2.75, I would call it, through the first quarter of next year. So protein is definitely much higher than fat. So what about fall risk management decisions? So I always like to take the latest Class 3 settlement, which was July, and say, what happened 6 months ago? How smart were we back here? And it turns out it dropped $1.84 from that point, and it actually ended up at $15.52. If you would have sold your milk here, you would have been very upset when we hit $19.02. And then you would have been very excited when we hit $15.52. So risk management isn't an easy thing, and you've kind of got to decide what is the best scenario for you. Now, the safest strategy is DRP. So it's kind of like just buying insurance. So you pay the insurance premium. The most that you're going to lose is the insurance premium. And if we look at where DRP prices are, and this was as of 7 o'clock this morning. So again, Class 4 is over top of Class 3. And what you want to look at are these numbers here, which is the average of the DRP for the different quarters. So it's quite clear that the Class 4 is going to be higher than 3. So probably you want to focus a little bit more on 4. And for me, I would never do anything other than DRP for 4 because that market has got such low liquidity that it's got a very high volatility to it. But right now, this Q4 DRP number is the highest it's been in a long time at 1816. These are numbers that you may actually want to look at protecting. Now, another strategy that I've talked to some producers about is when you kind of look at these forward curves, anytime you get $18 class 3, you probably ought to think about selling some milk, because I just don't see $18 here in the future. Again, if you sell a little bit here, if we climb up, sell a little bit more, sell a little bit more. So you're basically selling into that $18 to $19 rally. But again, in order to feel comfortable about that, you've got to kind of decide as to whether you think 18 is an upper limit that we're going to see in the future in the class 3 settlement. The other question is, going into the fall, should we really be focused on butterfat or should we be focused on protein? So to me, the biggest issue is you focus on healthy cows. There's no sense of really pumping out milk production at the expense of cow health and cow slaughter, especially where we are with black calves right now. And so the key to that is always excellent forages to promote rumen function. The better that your forage digestibility is, it's able to get more fiber into those cows and much better rumen function. And again, at the end of the day, it's always the case that more milk provides more pounds of components. This is not always the percent. So for me, the issue is butterfat, I think, is going to be under a lot of pressure here. If you just look at what the fat percentage has done across the country, again, this is for June, but again, it's the trends are pretty clear. And I told somebody yesterday, every load of milk has to have cream separated from it. When we're producing 4.3% fat, even full-fat cottage cheese is only 4%. So cream is coming off of every load of milk. And right now, cream has been taken up by ice cream, but that season is fast coming to an end here. It's kind of what's been going on here. And to me, the industry really changed in between 2023 and 2024. So we started making a lot more butter than we were making on non-fat dry milk. Again, this was fairly stable for the last 8 years, but then it took off, which means that we're getting cream from somewhere else. And then at that same time, non-fat dry milk really came down. Again, I think what happened is we didn't reorganize things a little bit. Now that's kind of recovered. But what this has done is just put the non-fat dry milk into tremendous supply shortage. So this is the spot market for non-fat dry milk. Back here in May, we ran clear up to $2.20 on the spot market. Now the USDA price never went above 208. Now this is slowly coming down. The blue line is the global dairy trade. So if we're focused on exports, we got to stay below that line. Right now we're coming back up with that. And there's a text yesterday I got that said, hey, Mexico is beginning to buy. This thing may take off again. I think the overall convention right now is that this is going to stay below $1.80. We're not going to run up to $2 again. But part of what's going on here is a big change in the industry as to where protein comes from milk. And again, big news for Michigan is that we're going to have a new Fairlife plant. And I think some of this action on non-fat dry milk is a result of not only Fairlife, but also, some of the Costco products that are high protein milk. Because what they do is they pull skim away from the balancing plants. And so there's not milk around to make non-fat dry milk in. And I was at Walmart the other day, and I took this picture. This is Fairlife's product at $5.28 a jar. Now, some of those you can go to Costco's and buy a case for $2.20, $2.30, $2.40. But this is a significant pull on milk, and I think it's going to have a nice impact for Michigan. And the biggest impact is going to be that it's going to keep non-fat dry milk at a fairly high level. So it is corn silage time. It's obviously a great time of year. I've been watching some of the different pieces that Novus Agroscience has put together, and I think they're really spot on. So I just thought I would put together a couple comments about this. And back in the day, I did work for an inoculant company, so I spent a lot of time evaluating corn silage and the impact of different harvest things. So I would just kind of summarize my experience here. Is too wet, you definitely end up with too much acetic acid and low starch. And I'm talking less than 32% dry matter. If there's water on your tires when you're packing it, it's probably just a little bit too wet. Now, too dry is never very good. I feel like Goldilocks here. Too dry is hard to pack, and it will actually impact your fiber digestibility due to the maturity of the plant. So again, somewhere between 32 and 38% dry matter is ideal for me. Got to remember that tonnage is really determined during the growing season. Trying to delay harvest to get more tonnage is probably not a good plan, because what you determine at the harvest is the quality. And remember, there is always an inverse relationship between starch and fiber digestibility. You wait a few more days, I just want a little bit higher starch, and then you end up with fiber digestibility that's low enough that the cows don't like to eat it. So again, that's not a very good scenario. Here are my ideal situation, and before somebody says, well, this doesn't look like BMR is on its way out. They're going to quit selling it, so I'm just going to talk about conventional corn. I want the kernels harvested before black layer, and ideally about half milk line or a little bit more. Ideally a starch around 38%, around 38% NDF, and biggest one that I focus on is fiber digestibility. If we drop that fiber digestibility below 60%, it's hard to be able to feed a lot of that corn silage without gut filling the cows. And of course packed, it's got to be packed very well and covered, and ideally with an oxygen limited barrier. Corn silage made right and preserved right is going to give you your biggest bang for the buck on any kind of feed that you've got. And overall, the drought monitor looks pretty good relative for the corn crop. We're a little bit dry, around the center part of Michigan, but overall it looks like you're definitely out of the drought. The drought tends to be on the western end of the grain belt and along the east coast here. Now for harvest, looks like it should be a pretty good harvest. We're about near normal, or maybe a little bit more. And I know we're going to be starting here in New York here probably in the next couple of weeks. So hopefully you've got a very good harvest scenario here. And again, more than anything, please be safe, because harvesting corn silage, there's a lot of trucks on the road, a lot of moving parts, and we just don't want anybody hurt. Finally, just kind of look at where this all come together relative to grain prices. So we've had a little bit of upward pressure on some of these grains, some geopolitical things. Is China going to continue to buy some of our grains? So right now, corn, is pushing on the board, about 175. That's outside what I call our normal range. I've got normal range from 155 to 170. So corn is pushing up a little bit. Beans have been high. They've came down here recently, and now they're ticking back up again a little bit. But grain prices are definitely on the rise, which again makes homegrown forages all the more important. I tried to take you a little bit on to some of the speculation, so nothing that I said should be taken as a trade recommendation. So with that, Ben, I'll turn it back to you.
Thank you, Larry. Novus AgriScience hopes you found this information insightful and look forward to next month's installment.